So, it's okay. Um, if hmm, hmm, I'm actually pretty excited about this. Um, hopefully, hopefully people come in because this is pretty freaking cool, in my opinion. The only thing that is a little bit off from what I was expecting here is going to be this. This was supposed to. Hmm, Okay, no one has joined. That's fine. Oh, it's because I should be there. Cool. Um, at least in theory, I should be there. Awesome. Cool. So now if anyone clicks the subscribe button, you should see um that increase, right? Um, nice. Okay. Now we're gonna kind of do a sort of like a portfolio update, and this is completely live. So make sure that you kind of keep an eye out for that in the future. Um, hey everybody, we're gonna kind of just go over my portfolio today and just kind of get an idea of like where I'm at with investing and everything like that. And so, just for a little bit of background, I am 25 years old. I currently work as a public accountant, and I've been investing for the last, 2 to 3 years pretty seriously, and then in the last, um, like I'd say 6 months to a year, it's been like really serious trying to, make up for the mistakes that I've made in the past, and kind of just accept those, and take them with a grain of salt. I mean it's tough to do, but I've made plenty of mistakes in investing, from you know the one that hurts the most is Dogecoin. I almost bought about $1,000 of Dogecoin when it was at 0.0002 cents, and then didn't buy it, and could have made millions of dollars there. Um, but so when I did really take on investing on a more serious note, um, I ended up buying um, lots of growth ETFs, and that's kind of where my bread and butter really was. So, as you can see right here on Snowball Analytics, VOO makes up $20,000 of my overall portfolio. And so I've invested $16,583 into this specific ETF, and from that, just with the price appreciation, which it's gone up about $4,300, that puts me at my $20,000, and this makes up about 56% of my portfolio. Hey, everybody, how's it going? Um, if you have any questions about investing, how to get started, or anything about me specifically, definitely feel free to drop that in the chat. I'm happy to answer any questions that you may have. So I'll try and keep an eye on that. Um, and as I've kind of shifted away, or not shifted away, but kind of transitioned my overall investing style, I am buying more dividend specific companies or ETFs. Like you can see, that second position there is Charles Schwab's SCHD. And SCHD, it's a absolute powerhouse in dividend investing if you haven't heard of it. Let's actually go ahead and take a look at some of the statistics that this does have. So it's currently trading at $28.10. Um, and with that, its dividend statistics are really where it's at. It has a 3.48% dividend yield, which isn't a crazy yield, but when you look at the overall dividend growth, that's when everything gets pretty awesome for a singular company. Over the last 5 years, it's increased its dividend payments by 11.3% on average. So, I mean, if you could get an 11.3% raise on, like, just at your typical 9 to 5 every single year, you'd be a very happy camper just because that would compound so quick. Um, so this has just done an amazing job, and I'm trying to make that be right around um, probably somewhere between 15 to 20% of my overall portfolio. And we're well on our way. I mean, it is making um, roughly 9% of my portfolio right now as we speak. Um, so as I work on increasing that, it'll kind of increase my overall dividend income, which right now I'm about $50 away from making $1,000 a year. So if we look at my dividend calendar, which is one of the nice things about Snowball Analytics, is it does show you exactly what income you're expected over the next 12 months and in the following year. So in the next 12 months, I'm expected to make $956.52, which is really solid considering that if I put that in perspective, um, that's like I get paid for working an extra, 3 or 4 days a year. And so as I continue to invest more and more, that will just continue to increase significantly. And for those of you who are new, go ahead and if you have any questions about investing or anything about me, go ahead and just drop that in the comments. I will make sure to respond to all the comments that I see. Um, but definitely one of my favorite things about Snowball Analytics is being able to see like when I'm going to be receiving my dividend payments. And as you can see right here, like I have payments coming in from CVS, and then about a week later, I get some payments from Abivai, Main Street Capital, Realty Income, Procter Gamble. I think especially as I get further and further into my overall career as a dividend investor, this is going to be a great tool just because I'll know when money's coming in. And if I'm using that to subsidize expenses or just pay for things in general, that will be, um, it'll just be a great tool, to be completely honest with you. And then those last dividend payments that I have are from Kenvu and Starbucks. But the next 12 months and in 2025, because they are so close together, um, I do have some very consistent income there. It's still $956, and that goes for it goes throughout 2025. The only thing is, it doesn't consider entirely um, the fact that I drip all of my dividends, all of the dividends that I receive, I just take and reinvest back into the company that paid the dividend. And with that, it's very slight downside to such an amazing platform. Um, but as you can see, like if we go into January of 2025, I'll be making about $75. Probably be a little bit more than where it's at right now at 72.85 by the end of the year, just because the way that that I invest is putting a few $100s every single week, about $800 a month into this account or all of these accounts, and just continue to build the positions the best that I possibly can. So if we go back to the dashboard, we can look at my overall positions that I am currently holding. As we can go back to those funds, I don't have a ton in any other funds other than VOO and SCHD. Um, the main reason behind that is I've been kind of buying a lot of dividend companies that are well respected and just have been paying dividends for a super long time. But I do own VTI and SPLG as ETFs. So VTI is Vanguard's total stock market ETF, and it trades very similar to VOO. They have very similar returns, and with that, some people would say you don't need to own both of them. You could just own one. But the reason that I do have both in my portfolio is one is slightly riskier than the other, and I think having some level of diversity it's good to have inside of your portfolio, and that is kind of the main reason behind my logic. And then the main reason I have SPLG in the portfolio is it has a slightly lower expense ratio when compared to VOO. VOO's expense ratio is 0.03%, where SPLG is only 0.02%, where it is a very small number. It's not going to be a life-changing difference for me in the long run, but being able to save as much as you can on expenses is still um, pretty important when it comes to, just trying to compound your overall net worth here. But in my consumer staples section here, um, you can see that I have Altria Group, Kenvu, which we'll look at in just a second, because I really like Kenvu and I think it has a ton of overall potential. Um, but then I have Procter Gamble, Walmart, and Coca-Cola. So very well respected companies in, the space of investing. You've probably heard of them all, and if maybe not Kenvu, but um, if you've been investing for any amount of time, you've probably heard of these. And if you haven't heard of like Procter and Gamble, just go look at pretty much anything in your bathroom, your toothpaste, toothbrush, anything like that, cleaning supplies. They're probably made by Procter and Gamble. Um, but one company that I feel like is going to have a ton of potential in the long run, not just in the next few months or years, is going to be Kenvu. And I actually got lucky here. If we look at the entire lifetime of Kenvu, is my average cost right now is at $19.55. So when I first heard about this, they were on a slight decline. And so I bought a handful of shares, and then I've had dividends that they've paid out be reinvested and fractional shares that I've purchased along the way. But this is a spinoff from Johnson and Johnson, so a very well respected company, especially in the dividend space. They've been paying dividends forever. Um, and I've looked at some of the line of product that they are taking with them for Kenvu, and I think it's just a very solid position to have in my portfolio, especially when I'm trying to focus on more of a growth side. I think their dividend yield will probably end up dropping to be around 1.5% to 2% in the next couple of years, just because the overall price of the stock is going to just kind of explode as people see that this is really that they're justifying their themselves in the space of investing. Um, so you can see it's currently trading with a dividend yield of 3.61%. So for every share that you own, you'll get paid 82 cents. But they're a very new company. They just started trading. Like they're a little over a year old. So while keeping that in mind, I definitely think that it is. I definitely think it's a very good thing to keep in mind with investing in newer companies like this. So I definitely think it's a good position to have in my portfolio, and I plan to continue to add to it, especially with the yield that it has. It is higher than my overall yield in my portfolio. My overall portfolio yield is at 2.62%, and my goal is to get that closer to 3% by the end of the year, hopefully over 2.75%. I don't want to do anything too crazy too quickly, mainly because with the election and everything, I don't exactly know where the market is going to go, and just trying to be as, cautious and as smart with the investing that I can. Um, that's kind of my logic there. So if we go into the next section of my portfolio, it really is only one company. It's only going to be Realty Income here, which I have about um, $2,345 in this ET or in this REIT. Um, but one thing that's really nice about Snowball Analytics is that this is designed for dividend investors like myself. So it is taking into consideration the dividend income when looking at everything as a whole. So what I mean by that is it's taking the overall capital gain, or in this case, capital loss, and it's netting that with the overall dividends that I have received. So I've have a capital gain of $22, and I've also received $20 in dividends. So net those together, I've only lost $2 on this company, as it has had a recent pullback in its overall share price. So we can go ahead and take a look at this company real quick. And it is a newer position in my portfolio. So keeping that in mind, you can see that I did recently just start purchasing it back in the end of July. July 14th was the first time that I had purchased this company. And about 7 shares. And then just as I made my normal deposits, I continued to add to the position until it made up about 5% of my portfolio, because that's about where I like to keep um, singular companies. I like to keep it right around 5%. If I want to add more to that, I need to be very cautious and just convicted that this is going to be a solid company for me to invest in for the long term. Um, um, oh, hello there, Lexi. How are you? If you have any questions about investing, any stocks, anything like that, go ahead and comment that below. I'm happy to respond to anything and have a conversation about investing in general or stocks, ETFs, whatever. So definitely drop a comment below. Um, but taking a look back at Realty Income, you definitely can see that, they had that pullback. And with the pullback, I think it's kind of creating to me, I think it's a solid buying opportunity. It's still, it's right about where my average cost on this actually is. Um, Sorry, I got a little sidetracked there. How is Tesla doing? We can take a look at Tesla. Um, let's go ahead and pull this up. All right, so let's look year to date for Tesla. I think that's a pretty good metric. I mean, they're pretty flat in the last for year to date. They're pretty flat. It's only up 0.2%. I mean, it's depending on where you've bought along the way. If you've continued to add to your positions, you're probably doing pretty well because it did drop all the way down to, a low of $147 per share, and now, it's kind of back up to about $250, which, that's pretty good. But if you've been holding it for longer than that, you're probably not super ecstatic with the returns that you would have gotten in the last 5 years. Obviously, you're going to be very happy. It's done extremely well. Um, but just in the last year or year to date, it hasn't done um, tremendously well compared to, like the S&P 500 or the Nasdaq. Um, but they don't have any dividend history. But Tesla overall as a company, if we take a look at their financial statements here, um, they're still pretty solid. I mean, just look back to 10 years ago. I mean, their revenue was 3.2 billion, and then 9 years later is 97 billion. That's a very impressive increase, just in a very short amount of time. Um, they're 30xing their business. That is pretty awesome to see. Um, I don't know if you want me to look super in depth to their, financial statements or anything like that. Um, I'd be happy to, but if you're not super familiar with it, you might not understand everything on it, which is totally fine. I mean, I don't understand it on the deepest level, but enough to figure out if I should be investing in the companies or not. Um, but yeah, Tesla over the last week down 5.15%. In the last month, they're basically break even, but in the last 3 months, if you added to your position, I mean, heck, 19 or basically 20% in a month is pretty solid. I'd be pretty happy with that. Um, well, cool. We can go back, jump back over to looking at realty income here. So one of the biggest reasons that I like to have realty income in my portfolio is their dividend yield is pretty high, especially compared to like my portfolio, as I mentioned a little bit ago. Um, yeah, definitely take a look at when you bought Tesla, because I think that will give you a good indication of how you've been doing, and then um, depending on the broker that you use, that has a little bit of a indication as well of how you've been doing. Like if you have like Robinhood, for instance, it tells you your average cost. So that's always good to know. But yeah, with the dividend yield here, we're talking a 5.37% dividend yield, which is a pretty high yield relating to my portfolio of 2.62%. And they have a crazy amount of time that they've been paying their dividends for 27 years, and they have been increasing their dividend by 3.55% on average. And year over year, that's pretty solid. Um, it's respectable. It's not the craziest increase of all time, but they still do a great job. But real estate, I mean, that makes up about 6% of my portfolio, and that is mainly just from realty income. And then going into financials, I really only have two companies in here. One of them I just bought Um, because like so Suntech Corporation, when I first started investing, this was kind of I found it, thought that maybe they could do something awesome, and bought some of it, and whatever. I it's probably not going to do anything, but it doesn't hurt to hold on to. Especially it only has a value of $15 there, so not super crazy. And then Main Street Capital is actually a the newest position that I do have inside my portfolio, and I only have 4 shares, but it does produce a decent amount of passive income. Each share is about 25 cents per dividend payment, and so that's basically $1 a month that I get in passive income just from having those 4 shares and having that $200 invested. And then the largest position in the financial sector that I have money invested in is UWMC, and um, UWMC has been bittersweet for me. I'm contemplating just fully closing out the actual position, and the main reason behind that is, you know, I started buying it when it was, two or not two, but like three, four, $5, and it ran all the way up to $9. And my goal was to sell it when it hit like 10 or 11, and its all-time highs was around 16, and I thought maybe we'd have a chance of getting back up there. And so I was planning on holding it. And then once it hit about $9.30, it just really started to fall off a cliff, and now it's trading at about $6.50. So I may close it all out. It does pay a dividend, which is at about 6%. Um, but I just don't think having that much volatility on, a portion of my portfolio, I don't think that's really the best move for my portfolio, especially as I'm trying to just, preserve and grow my overall wealth. But then if we look at my healthcare portion of the portfolio, um, I own Pfizer, CVS, Tilray, and very small fraction of AbbVie. I really like Pfizer. I think that eventually they're going to make a recovery back to where they were. They, you know, they're down quite a bit from their all-time highs. We can go ahead and pull up that chart. If we look year to date, down a tiny bit. In the last year, they're down 10%, which I haven't been buying for the last year, but the last 5 years, they're down quite a bit here. But their all-time high is about $60, which this is post-pandemic, and they were a company that had a vaccine, so they were getting some extra money there. Um, so I'm not going to pretend that that didn't exist. But I definitely think that we could totally see Pfizer coming back up and trading around $40 a share. Um, and then along with their dividend yield, which is around 6% right now, I definitely think that this could be a very solid play um, for me in the future. So I'm going to continue to keep holding on to some shares, and we'll see how that goes for me. Um, but yeah, this was kind of just a tester to see how everything would go with doing a vertical live stream with the dual screens. So if if anyone has any questions, go ahead and comment those down below. I'm happy to answer them. And if not, we will go ahead and call it a night.